Generally speaking, I'm a chartered accountant by trade, and I've been here since July 1st working on cases. And I thought, instead of doing the brief intro, just talk about a couple of things that have happened since I started. So I've been here for 6 months, and what you're going to see, the case you're going to see is an actual case. I've always liked to show you what we have in work in progress. I call it WIP. This one actually is a nice one because it got issued today. It's being issued today. So it's a WIP that's hopefully going to settle next week. So this case is with Jim Leo. And it was a fantastic case. And I'm presenting it not necessarily for the technical part, because you've seen me present this. I presented this exact same case, just different client, at the Spring University Day. So you're going to say, Frank, are you a one-trick pony? Absolutely not. I've worked on IFAs. I've worked on succession planning cases in London. We could work on anything. But these just tend to be the ones that are most common in our industry. And what I want you to get out of this is more so the process. And you're going to see that after I do the technical, you're going to see how is it that Frank worked together with Jim to get this to where I'd say 99% of the way. I don't want to jinx it, knock on wood, but we're 99% of the way on this one. So what are we going to talk about? We're going to review the actual presentation made to the client. So I'm working backwards. I'm going to show you what we delivered to the client, not necessarily what was sold, but what we delivered to the client. We're going to have the first advisor conversation, so the first time Jim and I spoke, a time for refinement, meeting with the client, what were the results after we met with the client, a quick debrief that Jim and I had after that meeting, and correspondence with the client. So when you see me put together a deliverable, what you see is what we as advisors show the client. But there's a lot of back-end calculations that I don't think are pertinent to that first meeting. Now, those back-end calculations, who are they there for? They're there for A, usually an accountant, or B, a financially focused client who wants to see my backup. And I have absolutely no problem sharing that backup and having the conversation with that client or that accountant. Final meeting with the client, application write-up, and then cover letter. And the cover letter, I'm just going to touch on how important it is. Does everybody put together a cover letter on cases? It's so important. That's your eyes and ears for the underwriter. Write a nice, short, concise, don't say, in this case, I asked the underwriter to comment on my cover letter. And she says, Frank, fantastic, you just get to the facts. She says, if you're talking to a group of people, please don't tell them that Jim Brown is a very nice man. It's not going to change, and we giggle, but that's the kind of stuff that goes into underwriting. Make the into the cover letter. Make the cover letter a serious correspondence between you and that individual. The fact that Jim Brown is a nice person and you see him at church every Sunday, is that going to change his underwriting risk? Absolutely not. So this is exactly the presentation made to the client. And remember, this is the first presentation made to the client. So we got Jack and Jill own Holdco, and this is something that is going to be implemented. But right now, Jack and Jill own ABC Corp directly, and we're anticipating the Holdco is going to be put in place soon. Tax rate in operating company, 13.5%. We know that, up to $500,000. We get a small business tax rate. Personal dividend tax is 45%, and I love to tell people, why pay the 45%? If you don't need cash, if you don't need to spend it personally, you leave it in the corporation. Your overall tax rate would have been 13.5% until you pay out a dividend at a future date. And I love making this point. I love saying to business owners, if we could make sure that you never paid an extra dollar of tax over and above the 13.5 cents, how would you like that? And what do you think the business owner's response is? Absolutely. I'd love to only pay 13.5% tax on my overall dollars. Right? And everybody in this room should know exactly what I mean by that. I've paid corporate income tax. So take $100,000. If I only earned $100,000 in here, I pay corporate income tax of 13%. I have about $87,000 left over. In a perfect world, if I put that all into an insurance policy, when I die, goes to the capital dividend account, comes out all to my family tax-free. What was the net rate of tax on my earnings? 13%, 13.5%. That's what our industry is based on. Right? That capital dividend account, it's as simple as that. Pay corporate income tax, never pay another dime of tax on those corporate earnings. So Jack and Jill, let's take a look at your investment portfolio. And we want to look at $125,000 a year into a fixed income investment versus $125,000 a year into a life insurance policy. And of course, if you put it into a fixed income investment, you're going to invest $125,000 per year for 10 years. And you'll see why 10 years is important here. I love using 10-year time horizons because I think that it doesn't paralyze the individual into saying, my gosh, you've given me a liability for a long time. 10 years is a nice finite time frame. Corporate tax on annual passive income is approximately 50%. And of course, we tax it as a non-eligible dividend when the capital is paid out to the shareholder or to the estate. So, Jack, $125,000 a year, you're going to deposit that for 10 years, and I'm going to get you 7% on a bond. Last time I presented it was 5%. I'm going to do 7% on a fixed income portfolio. My God, that's really unrealistic. But there's a reason why we use 7%, and I'll get to that after we do the debrief. How much would that $1,250,000, 125 times 10 years, how much would it grow to? Well, after taxes, at year 40, and by the way, the insured is 43 years old, spouse is 51 years old. We were looking at a joint last-to-die basis. He's 43, she's 51. He's 43, by the way, and these numbers are all based on him being rated 150 based on build. So at year 40, this joint last-to-die case is going to have a value, on the fixed income, not the insurance yet, but the fixed income portfolio will be $4,242,000. It's after annual earnings of 7%, net of corporate tax of 50%. Jack and Jill die, estate gets the shares of Holdco. Now they have to get the money out to themselves. They pay taxes of $900,000, including, or not including, in addition to the taxes each year. And by the way, my spreadsheets will show all those taxes. And they walk away with $3,328,000. Not really good. If you think about it, you've put $125,000 a year for 10 years. At year 40, you're left with $3,328,000 for the estate. And what if instead we look at this insurance policy? And I'll come right out and say the insurance company that we used, it was a BMO life insurance policy. It was a guaranteed 10-pay non-par product, one of their whole life products. And it fit nicely in this case. I use every company, so in this case, BMO looked good in the situation, and it was the one that made the most sense. I was asked last time I presented why BMO. I thought, let me get it off the table right now. So what if instead we take that $125,000 per year for 10 years in a life insurance policy on Jack and Jill, joint last to die, corporate tax rate on the annual growth, I don't know if you could see that because it's in green, 0%. No tax on the annual growth in the policy. No corporate tax on the death benefit received by Holdco. Death benefit minus ACB goes to the CDA, equals the CDA amount, and capital dividends are paid out tax-free. So as I go along through this presentation, I'm thinking there's a benefit that I haven't even referred to. Jim and I haven't even touched on the fact that if this gentleman has a portfolio that's accumulating in the corporation, what's happened recently in the budget? You're penalized on passive income that grows in the corporation, gives you a penalty on your active business tax rate. Everybody knows that. I've talked about it last time at the university, but generally speaking, I don't want to go into a tangent here, but generally speaking, if you have passive income over $50,000 in your corporation, you start to have a really negative effect on the tax rate. Basically, your corporate tax rate starts to go up because of it. None of that is factored in. The benefit of this plan is not even factoring in that benefit. So it's just that much better. Wow, the numbers are a lot higher than what we just showed. Death benefit. So total death benefit at year 40, $7,700,000. That goes into Holdco. I like to do this reconciliation on the left-hand side. $7,700,000 goes into Holdco. How much goes into the CDA account? My gosh, I wish it was 100%. It's so close to all of it, right? $7,650,000 goes into the CDA account, and we have a nuisance amount that has to get paid out taxable. That's fine. $58,000 is attracting tax. So how do you like $26,000 on a $7.7 million payout? $26,000 of tax. Absolutely, that's fantastic. And I love putting this slide in. Anyone that's worked with me knows I like using these slides. Everyone that's worked with me has seen these slides because we've done it. $3.3 million at 7% rate of return on your fixed income, or do you want $7,600,000 based on life insurance? And quickly, I love this slide as well because we all relate to what am I earning on a year-to-year basis. Well, you'd have to make 11.5% annually for the next 40 years. That's a really important number. Remember that, 11.5% annually for the next 40 years. Okay, and this gentleman, he's 43 years old, remember. So this case was more driven on the fact that we wanted to produce a retirement income. That was the utmost importance to him, was how can I get some income out of this? Yeah, Frank, it's fantastic that we can get such a high death benefit, but how can we get an income out of this? And of course, we're going to look at leveraging the policy. So here's a quick schematic of what I show clients just so that they get their head wrapped around how it works. Jack and Jill own Holdco. Holdco is the policy owner and beneficiary of the policy. Policy is assigned to the bank. Bank gives line of credit to Holdco. Holdco pays out taxable dividends to the shareholders. And then when the second death happens, insurance proceeds are going to go towards paying off the bank. Whatever's left over goes into Holdco, and it comes out via the capital dividend account. And I'm a big fan of let's focus on the presentation, let's not bring out diversions, so I don't pull out illustrations. I like to summarize key facts and figures on one quick spreadsheet here. I pull out year 20 for him, guaranteed cash surrender value, Mr. and Mrs. Client. You've put in $1,250,000, you're guaranteed to have $1,500,000, $1,468,000. That's guaranteed in the contract. Cash surrender value based on current -1, cash surrender value based on current. And then there's the death benefits. And what I like to put here, I can have a very high-level conversation at this point. Because the next slide, I'm sure most people will anticipate, I like to show a pension. And in this case, it was actually important because the gentleman wanted to see an annual income. He wants to see the annual income. But generally speaking, I like to show people this number. And I say, whenever you start leveraging, I don't care what the cash surrender value is at when you start leveraging. The important thing is, what does it grow to? Because that's your goalpost, right? We all know that if I start leveraging at age 60 and I have a $2 million line of credit, or I'm sorry, $2 million cash surrender value, most people aren't going to leverage $1.8 million at that time. But the important thing is, how much capacity do I have to leverage? Because over the years, I'm going to grow my borrowings. That amount is going to grow because I'm capitalizing the interest. I'm not paying back interest. I'm in retirement mode. So where's my upper goalpost, Frank? And in this case, the upper goalpost is $5.5 million at current -1, or $6,178,000 at current dividend. And here's a very important piece in this case. Annual loan balance. Well, annual loan balance is $187,000. So for 20 years, starting at year 20, his age 63, and going until his age 83. I assumed 83 to be his mortality, and her mortality as well. She's 51. They'll be able to take out $187,500. Annual dividend to Jack and Jill, $187,500. And what they walk away with is $103,000, assuming they're at the top marginal tax bracket. That's questionable. But worst case scenario, if you're at the top marginal tax bracket and the rates are still 45%, there's what you get. Net death benefit to the estate. So at year 40, after the loan is paid off, there's $2,681,000. And then I just do a quick comparison to say, okay, well, here's a quick snapshot. $1,250,000 goes into life insurance, $1,250,000 goes into fixed income investments. Cash into the corp. Well, I borrowed for 20 years. If I borrow for 20 years, it's $3,750,000. On the fixed income side, it's $3,750,000. I'm grinding down each year. Net death benefit, $2,642,000. Oh, nothing left over on the fixed income side. Credit to the CDA. Accountants love that. Accountants love it so much. Accountants love that even though we used most of the proceeds to pay off the banker, they're still getting a credit for the full life insurance proceeds. So why does that matter? I always bring this up when I talk about it. You only have $2,650,000 of cash available to pay out to the estate, but you get a credit for You get a credit for $7,650,000. Why does it matter? It matters because any other assets in that corporation will come out tax-free via the CDA account. There's nothing saying that a CDA created due to life insurance payout has to be used strictly to pay out has to be used to pay out strictly life insurance proceeds. A CDA is a CDA. So accountants love that. So that's that part of it. I wanted to get the technical part of it off the table because now I just want to give you a sense for how this all developed. What's the conversations that happened between myself and Jim? What's the conversations that happened with the client? Here's where I'm giving you a bit of process. So Jim recently saw me speak at the VP conference. We didn't meet at the conference, but we connected via a phone call shortly after. And during that phone call, I took down brief notes, but they were explicit enough that I was able to get a working copy and go out and meet with Jim. It was fantastic that we did that step, Jim, in the sense that we met first and made sure that I was presenting to Jim, let's iron out what is not working here. So, notes taken from the discussion. I'll advance to the next slide. But I'm going to read off what these notes have. So in my first point here, I have age. He's 43 years old, she's 51 years old. We got 7 years until retirement. Why is that 7 years important? Well, that 7 years is important because I don't want that time frame of paying into this plan to be longer or much longer than 7 years. After speaking to Jim, we thought, you know what? Really, is it going to be year 7 where he retires? Maybe not. That might be what his wish list is, but most likely he's going to be working a few more years. So we were comfortable with a guaranteed 10 pay. My second point is just chicken scratch here showing I got an OpCo. We want a HoldCo to be implemented, and the OpCo is making between $360,000 and $400,000 earnings annually, and it's much more than what he needs to live. My third point, which is very, very important in this, Jim says to me, Frank, we need $16,000 of pre-tax income per month. $16,000 of pre-tax income per month. So that's what I have to achieve, okay? And here's an important point. $100,000 to year 10. Jim says, Frank, let's run with $100,000. Well, when I showed Jim the $100,000 solution, we couldn't get there. I hope all of you picked up on the fact that we didn't go in with the $100,000 because we couldn't meet his needs. So you'll see that in a second. So when I met with Jim, I said, okay, Jim, if we put $100,000 a year into the insurance plan, yeah, fantastic. I don't have to waste time on what the insurance payout is because whatever it is, it's fantastic. But the driving factor here is income. So I went directly to the income page, and this is just a spreadsheet that I've developed, and it's got a bunch of spreadsheets behind it, but it's a spreadsheet that shows how much we could borrow. And I fast forward right to year 20. And Jim said right off the bat, he says, Frank, this isn't going to work. Because at year 20, what we could support based on the growth of the cash surrender value, I've fallen short. This number is $155,000. If I take $16,000 times 12, what I need is roughly about $195,000 of income. Call it $200,000 of income. That's what the clients asked for. So our plan at $100,000 just doesn't work. And there's at some point you have to be realistic to say, well, are we going to go in and show him a shortfall, or are we going to show this gentleman that for an extra $25,000 a year we can achieve his goal? So thankfully Jim was in agreement that we bump up the amount and we can get ourselves to that number. So at $125,000, I was able to get him a loan amount of $187,500, very close to what he was looking for. 16,000 times 12, we're pretty close to the ballpark of what he's looking for. Remember, that's what we went in showing him, $125,000 a year. Met with the client, walked through the presentation, and when we walk through this presentation, I try as much as possible, I like to talk a lot, but I try as much as possible to have the conversation go 50-50. I don't want those slides to be dictative in any sense. I want them to be conversation starters. So my perfect scenario is where I show a slide and the client comes up with questions on that slide. And the discussions are half the client, or even more than half the client, and then a little bit me and the advisor. But this was tough because we went through that presentation without a question from the client, without a comment from the client, and you're sitting there thinking, is this guy liking this, or is he thinking, Frank, hurry up and finish, because I got to get out of here. I got to go get a coffee. I got to do something. So I finally got to that slide that said 11.5% corporate insurance, and I couldn't take it anymore. I needed to know his reaction. I needed to know whether or not I was wasting my time. So I said, what do you think of this return? And he gave me a long answer. He says, it's good. He says, it's good. I said, oh my God, what's going on here? I have no clue. I have no clue. Jim's laughing because we talked about it after the fact. I wish I could tape record our conversation on the phone. I'm like, what the heck was that, right? But finally I said, okay, I got to get this guy to open up. So I said, okay, I'm glad you say it's good, because I've shown this to other clients before, and they've told me that they could get 20% rate of return annually for the next 40 years. And that's where he opened up. He opened up somewhat. He didn't open up totally, but he says, Frank, those guys are out to lunch. 11.5% for 40 years annually, that's good. Someone that tells you they could do 20% doesn't know what they're doing. Now, that's his thoughts, and I'm happy that he thinks that way, because I tend to think the same. 11.5% is a very attractive rate of return. Jim also surprised by the client being quiet, and he liked the fact that we had that distinct pause. So client liked it so much. Conclusion, client liked it so much that he asked if we could run the numbers at $150,000 of annual premium. So we went in starting, our discussion started at 100. We went in with 125, and client says, you know what, run 150,000. If you run 150,000, maybe I could start leveraging this thing earlier if I wanted to. So I do the numbers at $150,000. And what does the loan show up at? Well, what it shows up at, you can't see it here, I apologize for this, but the amount that we could leverage on this is roughly $200,000. Corporate loan balance annually is $200,000. $199,250. So we're now, with an extra $25,000 per year times 10 years, we're at $200,000. When are we starting to leverage? He says, Frank, leverage me as early as you can. So our idea started him leveraging at year 20, his age 63. Now he's leveraging at year 16, his age 59, his wife's age 67. Corporate loan balance at age 83, 6,700,000, cash value at cash value minus 1, 7,400,000. So he's liking all these numbers. One last meeting. So this was, I think we had 3 meetings, right, Jim? 3 meetings from start to finish. November 22nd, we just clarified again based on the new numbers, and there was a lot of back and forth. And what I quickly went through there, I didn't want to bore you with those slides of the spreadsheets, but those are the spreadsheets that I'm putting together, and they're the deliverable for the financially focused individual. This individual, I told you I was going to tell you why 7% was used. He's a mortgage broker, and he's yielding fixed income returns of 7%. So I cannot go in and show him a fixed income portfolio of 3% because he's going to laugh at us. So at 7%, I'm actually showing him what he's achieving in his fixed income portfolio. Finally, on November 29th, we met, we filled in the application, filled in all the necessary business forms, prepared the cover letter, and submitted the case to the carrier. So as I said, we just got an email today from the underwriter that it's being issued as we speak today. And there's my cover letter. What I'll tell you in this is just, listen, this is a corporation. Here's the financial statement, how they look. Here's the revenue for the past couple of years. Here's the net income. And what I like to do, I don't know if you do this, but I'm in the habit of giving a reconciliation of what's being included with the application. I'll tell you why I do that. So here I have signed copy of the insured retirement plan. I have articles of incorporation. I have this form. I have that form. Why do I do that? Well, I do it because if anything's missing, I want them to tell me. Here's what you should have. If you don't have it, please let me know. And it's also to keep the underwriters in check. And I don't mean that in a bad way, but a lot of times they're on us as advisors by saying, get us a cover letter. Get us a cover letter. Have any of you submitted a cover letter that hasn't been written by an underwriter, or hasn't been read by the underwriter? It's a couple people nodding. So I keep them in check by saying, oh, you didn't get that, but didn't you get my cover letter? My cover letter listed everything that we submitted. So that piece of information you're asking for maybe got lost in the shuffle. Maybe it was us, maybe it was you. But if you read the cover letter, then you would have sent us an email just to verify. So enough of that. I think that the last thing we're going to do is run a video where Jim gives you his view on how the process went.
I met Frank at the President's Conference earlier this year. At the time, I had a client case that had presented itself, and I started the process of determining which insurance carrier to work with and potentially connect with one of their tax advisors. And at the Vice President's Conference, Frank was introduced, and I felt that it'd be a good opportunity to connect with him, and that way he would be able to offer an unbiased approach to this potential situation.
I first met Jim Leo at a meeting we organized. He saw me present at the VP conference. I did a brief presentation just to introduce myself to the participants of that conference. And Jim and I had a coffee just to get to know each other. And we both agreed that it made sense to have a preliminary meeting before meeting the client. And it actually was about a month or two in advance of our first meeting with the client. So it was good to get to know Jim on a personal level and to realize that the two of us could work well together.
So after the VP conference, I started to work on the case with my client, and at that point I recognized that I did need some assistance in terms of dealing with the corporate tax part of the equation. So I had contacted Frank by email, and we had a follow-up phone call, and I did explain to him the case and the opportunity, and he felt that it was something that he could assist me with. So after that, we ended up, I provided him with the information that he needed, and we did have a follow-up meeting in person to go through the scenario where he was able to ask me some additional questions, and then at that point he was able to take that away and work on a proposal, which we then looked at meeting with the client afterwards.
When I meet the client for the first time, I typically like to do a fact find. I don't like bringing solutions at the first meeting. The first meeting is meant to get facts and make sure that we know exactly what it is that the client is looking for. In this case, we didn't need to do that because Jim had a very good understanding of his client's wants and needs, so it made it simple to meet the client and give him a first draft. And the first draft was very close to the final draft, and the reason that we could facilitate that was, again, because the fact find actually happened before the case ever happened between myself and Jim. Jim and I had a meeting, and I did a fact find with Jim, and Jim was able to provide the direction that we needed for me to be able to put together, as I said earlier, a first draft, a working draft for us to discuss with the client.
The next step in the process, quite frankly, was the client and I went back and forth with Frank, because the client did have some additional questions as well, and Frank was very clear in providing the answers.
And when I met with the client, the process was just ensuring that we had our facts correct. The corporate structure was a bit refined, and there was discussion as to what next steps were for us to implement the correct corporate structure. This didn't come as a surprise to any of us at the table, because it was one of the open items that we had as part of our discussion. Again, the presentation we brought was not meant to be a complete presentation, so it allowed the open discussion as to how we would structure the deal so that it worked as efficiently as possible. The amount of refinement didn't necessarily happen at the presentation level, but it happened at the calculations level. And what I mean by that is there's substantial spreadsheets that happen behind the scenes, which most clients don't ask for. Those are used for the client discussions, or I'm sorry, for the accountant discussions. And clients don't really want to get their hands dirty looking at spreadsheets. With this client, again, being a financially focused person, he wanted to see the spreadsheets, and he came back several times and asked for different alterations and different iterations of the original numbers that we began with. I gauge whether or not I'm getting through to a client based on the feedback, and every client is going to give me different feedback. The obvious one is questions. When I'm meeting with a client and presenting to them, it's not about me. I try to talk as little as possible, and I try to assess whether or not the client's understanding and is following through. In this meeting, it was extremely difficult to read John because he wasn't giving me that verbal feedback. So at a point in the meeting, I actually stopped and asked him directly to ask me questions. I challenged him on it, because I needed a gauge as to whether or not this was resonating with him or it wasn't resonating with him. So I think that that's important as advisors, is to make sure that you're not doing all the talking. Make sure that you're checking in with the client and ask them to ask questions. My slides are not meant for me to dictate. My slides are meant to start the conversation. And the conversation that I want is an open conversation back and forth. I want clients to ask questions when we're going through that process. And really, my optimal presentation or meeting is most of the talking is done by them, and I'm just answering their questions. When I first saw the client, the first draft was good from a structural perspective. The surprise that we had, which was a nice surprise, is that he asked for us to redo the presentation or redo the numbers with a much higher premium. So Jim and I went in pitching or showing a $100,000 annual premium for 10 years, and the client liked the idea so much that he said, I'd like to see the same idea using $150,000 of annual premium. This $150,000 annual premium helped achieve his retirement income goal.
With the client, we ended up having approximately, I believe it was 2, maybe 3 meetings by the time we started off with the initial presentation, with a follow-up, and then finally completing the application and submitting the application. I think what the client really appreciated was the fact that there was some tax benefit in implementing this corporate strategy. I find that most individuals just don't understand the impact of owning corporately owned insurance in a corp. So Frank did a very good job of explaining, what he was currently doing, because he did have retained earnings in a portfolio within the corp, and the impact of what that investment would look like 10 to 15 years down the road, and then compare the impact of investing in the corporate life insurance and providing the investor, or sort of the client, with an income stream at retirement without really worrying about any major investment risk. I have involved Frank in actually some additional cases after this initial one, so we're currently working on about 3, and I feel, I've been in the industry for 25 years, I have no issues with preparing an insurance case or an illustration, but understanding the individual client's tax situation in detail, it's not something that I can really do because I'm not an accountant, so bringing in someone with Frank's expertise definitely helped. I believe helps me bring that case across the finish line.